Hello, welcome to LCG's preview for the week ahead. I'll be discussing the FOMC rate decision, non-farm payrolls, quarterly earnings from Apple, 3% US 10-year Treasury yields, and the return of US dollar bulls. Before that, I'll run down some of the highlights for another big upcoming week for corporate results. So on Monday, Allergan and McDonald's report first quarter earnings. On Tuesday, BP, Seagate, Snap and Apple report quarterly results. On Wednesday, J. Sainsbury report full year results, Sage Group its half year earnings, then Inmarsat, MasterCard, Spotify, Kraft Heinz, Square and Tesla report their Q1 earnings. And then finally on Friday, it's Adidas, GoPro, Pandora Media, BNP Paribas, Societe Generale, BMW, HSBC, IAG, Air France KLM and Alibaba, who all report first quarter earnings. Now moving on to the economic calendar, on Monday there is China manufacturing and non-manufacturing PMIs, German CPI, US personal consumption and US core PCE. On Tuesday, it's Labour Day, meaning a lot of the European markets are closed, but we do have the Reserve Bank of Australia rate decision. On Wednesday, it's Eurozone Q1 GDP, Eurozone unemployment, US ADP unemployment, and of course, the Federal Reserve rate decision. On Thursday, it's the preliminary Eurozone CPI for April, and US factory orders. Then on Friday, we round it off with US non-farm payrolls and average hourly earnings. So as per normal, the FOMC rate decision, the Federal Reserve deciding monetary policy, that's going to be front and center for the week. But there is no press conference, so we don't expect any decision to be made. We're just going to get a statement. So we'll be looking to see how the Fed, if at all, they tweak the language. Obviously, we know the backdrop to this is that actually, in terms of market expectations, it's creeping up towards 4 rate hikes in 2018. Hence, we've seen some of the sharp reaction in Treasury markets and the dollar this week. So it's a matter of how they balance, how they view the incoming US data, which is mostly surprise to the upside, and how they generally infer how many rate hikes there will be this week, this year. But of course, we don't have any update to the dot plot or anything like that. So it's going to be limited information, but we're expecting the Fed basically to stay the course. And the most interesting thing about that probably is that the other central banks that we compare the Fed with, the likes of the Bank of Japan and the ECB, they've been to some degree backtracking from plans to exit their stimulus programs. The next big economic data event of the week is non-farm payrolls on Friday. So we'll be doing our live coverage webinar, which starts at 1:15 in London. The expectations, I'll give you the numbers here. It's 185,000, although I've seen a range of 185,000 up to 198,000 for the headline NFP number. 0.2% on wage growth month over month, and 4% on the unemployment rate. So that contrasts with last month. You remember there was a pretty disappointing 103,000. The wage growth was better at 0.3%, and then we had an unemployment rate of 4.1%. So looking for a slight improvement there. So obviously earnings will play into it, as we've talked about before, in terms of what that means for the inflation outlook. But increasingly the headline number is starting to matter, just because, as I mentioned, the US economy for the most part has been surprising on the upside, last month's NFP being a notable exception, whereas other parts of the world, notably the Eurozone, has been disappointing to the downside, in Q1 at least. So if we see that kind of continual trend supported by the unemployment figures, that again will add support for the US dollar and probably increase the spread between US Treasuries and German Bunds and Japanese JGBs. So in terms of the quarterly earnings for Apple, obviously we've got lots of results out this week, but Apple always a bit of a bellwether. And there has been a lot of focus on Apple suppliers reporting some kind of difficult numbers, giving tricky outlooks for smartphone demand going forward. And obviously Apple's entire business model centers around the iPhone. So if there is going to be slightly more lackluster smartphone demand going forward, then you would expect that to weigh on Apple's results. So actually, the good thing about that is that the bar has been lowered in terms of what analysts are expecting from these earnings from Apple this quarter. So a bit of a better chance of Apple beating them. So it's always a contrast of how the actual numbers turn out themselves and then what the outlook is going forward. So we'll have to look at both those things, whether in fact Apple beat profit and revenue expectations, and in terms of number of iPhones sold, and what their guidance is for the rest of the year. If they guide down, maybe even talking about the risk of a trade war between the US and China, where China is a big market for Apple, then you could see the Apple share price retreat even further. One additional thing I wanted to mention on Apple is that although the iPhone sales may be down, we remember that now they sold the iPhone X, which reportedly they're going to stop selling soon, but they've sold that for $1,000 per phone. So what Apple are doing, they're charging more per phone. So actually, maybe it doesn't matter if the number of phones they sell goes down, they can still increase their profits from it. So maybe that's a reason not to take as much meaning from Samsung, who reported last week, talking about a bit of worry on the smartphone demand side. The other big theme for markets at the moment is that US Treasury yields hit 3%. So that's the 10-year US government bond. The amount of money you earn on that over the course of a year is now 3%. So what that means is that the price has been going down. Now there's two things going on here. One is that inflation expectations are rising, so bonds need to yield more to pay for that higher expectation, that higher inflation level. And the other thing is that investors, just more broadly speaking, are selling government bonds. That's in anticipation of later this year, the net purchases of government bonds from central banks around the world is going to turn negative. So for the moment, the ECB and the BOJ are purchasing more than the Fed is doing. But by the middle of the year, the Fed will be selling enough bonds that actually overall it will turn negative. And the market's already starting to price that in. For us, 3% by itself is not necessarily important. Obviously, it's a level that gets everyone talking. It's a psychological level, which in of itself can be important. But I think overall, the trend in bond prices is down. The trend in bond yields is higher for the time being. And this all ties in with what's been happening in currency markets. So the spread between US and German bond yields on short-dated paper, that's the widest it's been in 20 years. So you're getting a lot more money, return on your money in the US than you are in Germany, which is a good proxy for the rest of Europe and other parts of the world. So people moving their money back into dollars because you can earn more interest on it. And obviously that all feeds back into the fact that the Fed are gradually hiking rates. They just did so in March, not going to again in April, but still, as we mentioned, probably 4 rate hikes this year. Whereas the ECB, in its policy decision last week, there was absolutely no mention of when the stimulus program is going to end. And with data in Europe disappointing somewhat in the first quarter, it's probably pushed back when they're actually going to start talking about that. And similarly in Japan, they actually removed part of their statement which talked about when they expect inflation to hit 2%. So a bit of a backtracking from those. Obviously, the yen and the euro suffer a result, and you see the dollar strengthening. And then you could argue it's other parts of the world as well contributing to this dollar strength. For example, in the UK, chances of a May rate hike have drastically dropped. We've had some pretty soft Q1 earnings data, some soft inflation data for the month of March. So, I mean, a lot of that's due to the weather. We obviously had the beast from the east, but nonetheless, will the Bank of England really hike in May when they generally have such a dovish tone after such a weak quarter? Probably not, is becoming more likely. So again, weakness in the pound, that's all feeding into strengthening the dollar. Right, thank you very much for watching this week. If you do enjoy these videos, please follow LCG on YouTube and social media.